So, Arshad, let's start with trying to decode about our product and looking at the investment approach through which you manage our multi-asset product. So, the first question is, allocation is one of the most important parts of this sort of product. And history also shows that 90% of the returns come from the allocation part. So I'm sure everyone wants to understand how do you look at the allocation. So is your allocation more framework related, or you have fund manager bias while sort of choosing it? So overall framework, does it decide the overall allocation, or the flexibility is also given to the manager?
Sure. So I think we have both. If you were to ask me, I would put it more as a hybrid kind of strategy. So we do have our own internal framework which decides what equity percentage should be. At the same time, there is also flexibility with a fund manager. So for example, if the framework says that we should be X,
sure.
So fund manager has a flexibility that he can be X plus 1 or 2% or X minus 1 or 2%.
So he can take an overweight, underweight call.
Yes.
Based on.
So our internal framework, just for everyone's understanding. So internal framework is based on fundamental factors. So we have price to earnings, and we also have a differential of bond yield and earnings yield. So that decides where my equity percentage should be. If market moves up, typically we reduce our equity percentage and vice versa.
Sure.
Now coming to flexibility, or why I say it's a hybrid product, a hybrid way, is primarily because at some point in time there are some events which not necessarily get captured in the framework.
Sure.
So events like, I would say, some geopolitics situation, or let's say some MPC committee announcements. So those things are not immediately getting captured into the fundamental factors. So that's the reason we have flexibility. But otherwise, I would say since inception, 90 to 95% of the time we have followed our framework in terms of where the asset allocation should be.
So Arshad, moving to the next question, many of the products are managed quite dynamically, and many of the products are quite static in nature. How would you say is your approach for managing the multi-asset product?
Sure. So multi-asset as a category is a dynamic asset allocation category.
Sure.
So if you look at our framework, so for example, given that it's equity taxation, at any point in time we need to have at least 65% equity.
Correct.
So the framework doesn't decide gross equity, framework decides net equity.
Okay.
So net equity percentage can be at the lowest level at 40%, and at the highest level even can go up to 70%.
Okay.
So if you look at last 4 months, we have moved net equity from 51, 52 to 55, 57% or so,
Okay.
almost 4-5% increase.
Sure.
So somebody would say this was quite dynamic.
Correct.
Right. But if you go prior to that, almost 7 to 8 months, the equity range didn't move too much, not more than 1 to 2%.
Sure.
So that period it was a static kind of approach.
Sure.
So I would say eventually, if you look at this fund or any other multi-asset fund, so there will be periods where asset allocation could be static. There will be periods where asset allocation could be dynamic. But at
Sure.
the core of it, I think it's a dynamic asset allocation product.
Sure. And like you rightly pointed out, Harsha, the idea is to always be greater than 65. So the balance will be in arbitrage. So you always get the benefit of equity taxation. And I think so people always get this confusion that dynamism is always right. But time and again we keep saying time spent in the market is more important than timing. So you don't need to be sometimes too dynamic in the way you change allocation, because getting all the calls right is very difficult. So maybe a mix of dynamic and static can be a good approach, which you would be sort of following in this product. Arshad, going to the next product, next question on this is that every fund actually claims that they have a different shaded approach in asset allocation. Could you help us understand what genuinely differentiates you from some of your peers, whether it's from research, from framework, from overall thought process team, etc., that you would like to highlight?
Sure. So I think if you look at the end result of any fund, which is the returns.
Sure.
So returns for particularly, I would say, asset allocation products is nothing but a sum product of returns in each asset category and how much you allocate to that. So I think in that context, I think the framework, particularly what I explained earlier, for us, so framework can eventually become commodity. It's not that it's not somebody else can't do it.
Correct.
I think what differentiates X fund from Y fund, I think what and how you buy within the each asset category.
Sure.
So eventually, I think what I believe is that for example, in multi-asset category, see if you look at debt, a piece, so their returns can range between, I would say, 6 to 8.5, right? If you come to arbitrage, similar kind of range.
Sure.
Two asset classes, one is equity and second is, I would say, commodities for us, which is gold and silver till now. So I think what will matter is what you buy in the equity and how you buy it.
Sure.
So here I think what we believe is that at Mirae Asset, since I think 2006-7, if you look at, we have been managing equity asset class, and I think there is where the fundamental approach comes into picture. So if you look at our own approach, we have this BMV approach here, where focus on business, we focus on management, and we focus on valuation.
Sure.
So any stock which is a part of a equity portfolio, there from the business point of view, what we look at, there should be a visibility of double-digit top line growth at least for the next 3 to 5 years, if not more.
Sure.
ROC, underlying ROC should be at least 12 to 13% post-tax basis. From the management point of view, while obviously difficult to say, one management is A, B or C category, but
sure.
what we do try to look, typically a balance sheet of a company should be similar into the same business. There should be, if possible, there should be a dividend history, capex increase. So to that extent, there should be revenue increase. So these are some parameters which
sure.
you look from the management point of view. On the valuation side, while it is very easy to say, look at PE, price to book, EV by EBITDA, but those all relative terms, right? In a good market, even 40 PE might look okay. In a bad
right.
market, same company at a 20 PE, somebody might say it's costly. So what we focus is on the DCF based methodology, discounted cash flow. So it's more of a fundamental way approach, to value
sure.
any company. And last is a portfolio construction. So there I think what we do is a core and tactical approach. So
okay.
any company which we buy, typically buy from a 3 to 5 year perspective. It's the last 5 to 10% within the equity where it's more tactical approach what we do.
Sure.
So the combination of all this culminates into the equity returns.
Sure.
So I think this is what we differentiate from A team versus B team.
Sure. So I think overall, like you mentioned, the overall approach, the team, the kind of research that you do is what should sort of make you different from some of the peers in what could be a commoditized category as well. So thanks Arshad for trying to explain the investment framework for the multi-asset product and also try and explain the overall approach in which you will be managing this. So thank you everyone for joining in today and hope to connect with you soon.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.